Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market Site, we have Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk, and Chris Englebert, Founding Partner and CIO of Englebert Investment Advisors. We're here to discuss summer strategies. Investors turn their attention to the back half of the year. It's great to have both Chris's on the desk. Another Chris back in production. We have the trifecta here with us today at Market Site. You know, it's interesting, Chris, as we think about year-to-date returns in the S&P 500, the index is up spot 6.8%. Let's think about it. All the moves in between. You had April 3rd and 4th decline by 5% and 6% respectively. Then on April 9th, it gained 9.5%. It's 8th largest in history. Yeah. Right? So if you look at just the year-to-date performance, the story is very different in between. Yeah, I mean, if people don't look at the charts, they're like, oh, not much has been happening. But what we're really trying to have clients understand is that this is going to be the summer of the whipsaw. You know, the markets are whipsawing back and forth. They're whipsawing back on whether we're going to have a tariff or not going to have a tariff. Are we going into a recession or not going into a recession? Are we having inflation or not? And every week we get different numbers that are coming out going, hey, looks like we're going to be in a recession. And the next week, purchasing managers, oh, it's not that bad. And then right now we've got the Fed more concerned about inflation than they have been for the last couple of months because what? They're worried about what the tariffs are going to do. Now, again, you know, whether or not the tariffs are a negotiating tool or whether or not they're going to be something that's going to be a concrete long-term strategy for the United States is still up for grabs. And that's what creates this whipsaw because we've just seen over the last 2 months, and again, we see it coming the next couple of months, that any news coming out of Washington, you're going to get these 2%, 5%, 10% moves. I've never seen a 10% move in the equity markets in my career, and it was breathtaking, but it's really leaving, you know, the average investor going, what am I supposed to do and what's going on? Right, and the whole point of public markets is to make sure that the public investor can contribute to the growth in U.S. companies. Chris, it's almost like flooding the zone and drinking through a fire hose when it comes to the news, and I think that's something that we can expect for the time being, you know, certainly throughout the next three and a half years. I wonder at some point if the market is just going to get exhausted with all of this. You know,
investors have been tilting very defensively since the beginning of April. And you're seeing it not only with the investment cycle, people, how they're putting their money to work. They're looking for other investments outside the U.S. now, especially on the international
Which was
front.
a trend prior to Liberation Day.
True, but that really,
here.
Right, that's what we talked about before off camera, but it's really come to fruition over the last month and a half. I mean, you're seeing treasuries being sold. You know, I read an article today, and I'm not, you know, I'm an equity guy, so I'll take it with a grain of salt, but the UK is now the second largest holder of U.S. treasuries, surpassing Japan right now. So that's an interesting stat. That was in the Journal this morning. So, you know, I didn't get a chance to look at that, but even if it's coming close to that, you're seeing other investors move out. You know, Europe's a great place to be right now from an investment standpoint. Japan's a great place to be. China's still got a lot of work to do, but there's other alternatives to the U.S. economy right now because of tariffs and the uncertainty. Really, the defensive trade for investors right now is really, I don't know what to do. Do I buy and hold through all this? Do I sell and go to cash? You know, it's really a tough decision.
Which is interesting, Chris, because the TINA trade, you know, there is no alternative, certainly is in effect now. And prior to, you know, from the beginning of the year, actually, and before Liberation Day, you saw the outperformance in European equities just because the risk was to the upside, the valuation was much more attractive. So if you take that factor out of it, the fundamental case exists now as well. Yeah, and finally, what the other thing, part of that is that valuation levels. I mean, the Mag 7 stocks, which we all know what they are, have sucked up so much global money, so to speak. And people are looking at the Mag 7 stocks going, wow, that trade is really long in the tooth. And I really thought during the April sell-off, when they sold off hard, that again, once again, that was the beginning of underperformance. But if you look at them, they did bounce back very well so far in the second quarter. But, you know, to your point, Chris, you know, you got global investors going, we can't be in just 7 stocks. We got to be, you know, crypto, we got to be U.S. bonds, we got to be international stocks. Right. And the valuation level, I mean, our model is finally showing that, you know, we started buying, you know, international about 2 months ago. I think you're going to see a longer term catch up in performance of international versus U.S. The valuation differential, the only thing that's the second most undervalued asset class
international equities versus U.S. equities is on the U.S. side. Small mid cap is also extremely undervalued. So again, I think once we get through this whipsaw, on the other side, people are going to be like, okay, how do I diversify myself? Where do I diversify myself? And is this going to be the trade for the next couple of years? Which I think it is. I think the other thing that we keep leaving out is the bond picture. Everybody's talking about interest rates coming down. The Fed is scared to death that inflation is going to resurge at some point this year, and they are trying their hardest to keep short rates elevated. Now, short rates should actually be around 2.5%. If you look at the 2-year Treasury note, that's a proxy for where short-term rates or Fed funds should be. It's hovering around 4%. It's still probably 1.5% too high if you talk to bond people. But again, the Fed is scared to death about reigniting inflation and then going into a mini recession or a major recession, having stagflation. So, short-term fixed income, you talk about hiding someplace, still a very good alternative to try to control the volatility and the whipsawing that's going on in portfolios.
You're protecting your principal.
Yeah.
Right. That's what it comes down to. And if you can't protect your principal, why are you going to be into the markets, right? It's that time value of money, right? What is it worth right now compared to what it's going to be worth a year ago? Do I sit on cash, or can I get something for it? And it's getting something for it that you're seeing investors move. So where else are we going to go?
Right. Well, just for clarity here too, the UK surpassed China as of last week as the second largest foreign holder. Japan still is number one. It's the first time that U.S. Treasuries, for the first time since late 2000, as Beijing has been scaling back, and of course, of Moody's stripping the U.S. of its top credit rating. It makes you wonder, Chris, what's more concerning, what the Fed is doing or what we're doing with fiscal policy? I mean, the latter concerns me more. Yeah, so,
one of the things we're talking to clients about, and it's not on everybody's radar, but, we've just heard about the big, beautiful bill. Last time I was here, we talked about it. As of this recording, it passed the Senate. The House is going to the Senate. It's got to be reworked. The best thing about it is that there are no new taxes. The previous tax cuts are, put in place, which they knew they had to do. This wasn't, hey, we might not pass this. They had to pass this because if you would have let those tax breaks roll off, it would have been bone crushing to the retail consumer. But the real problem I have with it is, again, there's been a lot of spending. There's been a tremendous amount of government spending. We need to bend that government spending down, but both sides of the aisle, nobody seems willing to do it. They can talk about DOGE all they want and cutting spending around the edges.
No one's going to
it's just not. So my concern is it's not happening from the spending standpoint. And the real question, and again, people get into this parade of imaginary horribles. You got this government debt piling up. Does the downgrade mean something, et cetera? Well, it kind of does, but if the underlying U.S. economy is still strong, which it is, we should be able to grow our way out of this over the next couple of years. The question is, how much weight in the wagon are you going to put to make it harder for the U.S. economy to grow? And I think that's really where we are.
I'm just surprised that the reaction to the downgrade was as muted as it was.
I am too.
Because the whole premise of the campaign and from day one, the first 100 days, it was all about to cut spending.
Right.
So to your point, we knew there wasn't going to be taxes raised. That part was going to stay put as expected. But adding another $3 trillion, that really wasn't in the cards.
Right, and so again, how much weight do you put, where you can't have the economy overcome that? And so the real question is, and what I'm waiting to see the third and fourth quarter is, are we going to be able to grow our way out? Now, earnings came out. We're done with earnings season, except for a couple of big stocks. Yeah, and earnings were actually better. They were up about 11.5%, almost 11.6%. They were forecast to be up 6.6%. So I think a lot of people were surprised, but I also think you had some pull forward from companies doing the getting inventory before the tariffs going. This is almost a repeat of COVID 2.0 where everybody's buying everything before everything gets shut down. Now the question is going to be, over the next 9 months, are we going to be able to work through that inventory? Are we going to be able to grow the economy? And again, that's why I'm saying, this is the summer of whipsaw. Is it tariffs? Is it inflation? Is it recession? all those data points are coming into play, and one day it's this and one day it's
so Chris,
that.
it's interesting. You cover the consumer, and I just want you to hear my point because this relates specifically to your world, right? So Hyundai has a commercial on saying that we're working with the U.S. consumer, that we won't. Our prices, our MSRP prices, are going to remain the same till June 2nd, 3rd. They're essentially telegraphing that we're pulling this forward because there's expectations that tariffs are going to create price increases in MSRP. It's a subtle way of marketing that.
Right, and, Ford's done a similar campaign over the last couple of months too, a couple of weeks, saying that we're going to give you employee pricing.
Right. Do you know that demand is being pulled forward?
Right. It totally is. So with the tariffs, you have supply chain issues that, to Chris's point, people are pulling forward. You also have consumer prices. Am I paying more? Or am I going to pay less? Because I don't know where we are right now. There's a study out right now. I just want to make sure I get this right. That says that tariffs have already raised good prices by about 1/3 of a percentage point, with increased future inflation remaining a concern. Right. So when you look at that and you look at the Fed and they're trying to keep inflation down, we have a meeting in June. There's not going to be any cuts there. There's a 60% chance that we might see a 25 basis point cut in July. Again, the data's been pretty good. The economy's coming along. Unemployment's still tame-ish. Inflation is relatively in line for the most part. Wages are growing, but not at the best level. But the economy is still humming along, and it's coming into the summer season here. So the question is, where's that spend going to go? If you look at the consumer names on the retail side of it, the larger names can actually weather the storm here. They can take price, they can pass along or eat the margin differential, but the small and mid-cap names in the space cannot. Right. And you're seeing a lot of companies, especially in consumer, pull guidance, right? Ross Stores just did it the other night, on their earnings.
Which is concerning because
they're buying already existing inventory. They're not importing.
Right.
So they're telling you that it's starting to leak through. People are uncertain. How can you model out? Right. You're looking 2-3 quarters out. If I'm an analyst or if I'm a corporate treasurer, how can I model out if I don't know what the cost is? You throw a 50% tariff on the EU, then you pull it back a couple of days. The markets react very nicely to that on Tuesday. Monday was a holiday, but you don't know.
Right, but here's a concern though. We know, the underlying support in this market has been the strength of the consumer and employment for the most part. If you want to work, you're working. So a couple of weeks ago, the World Travel and Tourism Council expects a significant drop in 2025, projecting a 7% decline from 2024. That's about $12.5 billion. Guess what? The service sector is a big part of the labor market.
Yes, it is.
And that's concerning because then you can see the trickle-down effect. If they are, if we expect that kind of decline,
people are going to spend money where they see fit. And entertainment, experiences is where that money is going to be spent, right? Are people going to be buying new wardrobes? Yeah, to a point. But are they going to be buying chutskis? Probably not, right? And we've already experienced that coming out of COVID over the last 2 years. So that shift continues to spend. AAA had data out the other day that this is one of the best travel weekends in history for the U.S. So when people are going places, they're spending money, right? Whether they're going to visit friends, they're going to the beach house, they're going to wherever it might be. People are on the road spending. So that means they're consuming gasoline, right? They're eating out and whatever their experience is. So people are going to spend.
Yeah,
and if you have a job and you make money,
and the key is the employment markets. I mean, there's no question about it. As long as the employment markets stay solid like they have been, you're exactly right. I mean, the consumer is very adept at switching their money, where they want to spend it, and they're like, hey, I'm not giving up the vacation, I'm not doing this, but they'll cut back on other things. But to your point, it was interesting. We had a client in the other day that works for a specialty dog food manufacturing or pet food manufacturing, and he's like, we're going crazy because the lower end, people are not spending the money, but the higher end goods and services are where people are saying, if I'm going to have an experience or I'm going to do something, I'm going to spend that money. That's been holding together very, very well.
But, okay, here's another point, though, and I'm just playing devil's advocate because, of course, I want the economy and the market to do well and so forth. But as reported by Bloomberg, New York City officials, they cut their forecast for the number of international tourists this year by 17%.
Yep.
We saw what happened during COVID when we did not have an influx of people in the city. 17%, that's nearly potentially a fifth of if you want to break it down into buckets, that's...
I'll take the other corner of that. What if you have domestic travel? Instead of traveling internationally, especially with where the dollar is right
It's
now.
cheaper to fly internationally than it is to fly within the 50 states.
It is, but will people travel to New York instead of taking a vacation to the Bahamas, right, or going to Europe? That's waits to be seen. I'm cautious about that, but to Chris's point before about consumer spend, the top 10% account for 90% of consumer spend and growth here, right? So when you look at that number, those are the people who have, those are the people who will continue to spend, and that's what's driving it. It's not the tail, it's not the lower income, it's not the folks who are paycheck to paycheck or worse, right? And that's the spend that's really
But see,
concerning.
here's
and
the
that's
variable.
The population.
But this is the variable this time. It's not about the 90% and the 10%. This is, again, this is, as Bloomberg has reported it, according to New York City officials, that hardline positions on tariffs and policies on immigration is deterring visitors. That has nothing to do with what they can afford. That has to do with conscious decisions that they're making in terms of where they want to put their money, not based on income, but based on values, if you will.
Well, and one of the things that always happens with government policy is government policy has been, it's like a pendulum, and it swings back and forth. We had it swing one way pretty severely. Now it's swinging back the other way pretty severely. I really think one of the reasons the current administration, and the main reason that they're trying to move so quickly with a lot of these policies, whether it's tariffs or immigration or crypto exchange, et cetera, is that they know they're going to lose momentum at some point, and policy is going to shift back to the center. That may not be a bad thing. I mean, having some type of more centrist policy is really, I believe, the underlying, push of where the country's going.
Which is interesting because digital assets has bipartisan support.
Correct.
We would not, the conversation would have looked a little bit different 2-3 years ago, but that's, and not just for the trading, the value and so forth, but the underlying infrastructure and how that could advance capital markets. The investment thesis is much different than it was, and I think with regulation expected to be passed sooner than later, and actually having bipartisan support is it's interesting.
The regulation is desperately needed. I mean, we have clients and we've used the crypto ETFs, and again, my whole thing is, if they're down big, buy them. If they're up big, don't make it a huge part of your portfolio. But there's a lot of the other crypto products out there that, again, it's the Wild West, and people have lost tens, hundreds, millions of dollars. You need some kind of regulation to continue to have markets being, good. And I mean, look at the stock and bond market. It took years.
I mean, look, in the late 90s, a lot of people lost a lot of money in the dot-com stock. So it's not specific to cryptocurrency, but just understanding your investments. Exactly.
Look at cannabis. Look at some of the other hot names that come in where there's a lot of hope. You get it on the ground floor and it kind of sputters out. Right. I mean, realistically, what you're looking for, what the market's looking for here, is really minimal damage to the market and minimal damage to the economy, based off of what the tariff headlines are going to be from day to day. To Chris's point, the quicker he gets it out, the quicker the deals come, and we're hopeful for deals for calming in the market, the more we can get back to our normal day work and investment.
And that's what we said when he was on April 2nd for Liberation Day. At least the Band-Aid's been ripped off. We're not trying to determine when and if we're going to go through it in a year, 2 years. So, okay, now this is what we want. What's next steps? How do we execute?
Yeah, and I think, what we're telling our clients is, the rest of the summer, we're saying you got to be slow and steady. I mean, we're still value dividend stocks don't seem to get as whipsawed as much as some of the much higher beta, more aggressive stocks. Hide in short-term fixed income, pick your points. And when we do get a big down, like we did back in April, our risk indicators got extremely compressed. We put money to work that rebounded. Market's actually fairly valued now. So it's one of those things where we're not running, but we're actively watching where we want to place clients' money at this point.
All right, we appreciate the insight as always, Chris's. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.